My name is Bill Butler. I'm a Minneapolis attorney. I'm very interested in the anti-foreclosure movement. Federal Reserve is a central bank. It's essentially what would be described as a cartel, and a cartel has the power to set prices, and that's an unnatural state of affairs. Once you understand that, then you can start to really figure out what's going on. For example, the housing crisis caused by the artificially low interest rates that the Fed established starting in maybe about late 2000, actually before 9/11, which is interesting in itself. But the Fed dipped down interest rates, and what happens is, and the market likes normal interest rates of say 6%. And if the Fed drops interest rates to 1%, then all of a sudden you have a bunch of malinvestment. And the malinvestment generally goes into areas that are safe havens from, taxes. And real estate is one of those. Stock market's another one of those. And so interest rates go down, you see big bubbles in areas of the economy where the money flows into those voids, and the real estate bubble is clearly directly caused by Federal Reserve low interest rates, and now we're paying the price for it. When banks need to foreclose, they need to connect the original promissory note with the mortgage that is of record. And what happens with the robo-signing, which I think is a little overblown and somewhat irrelevant, but what happens is, that mortgage was executed in 2004 to Bank X, and Bank of America says it's holding the note now, so it's got to connect that mortgage to Bank of America. So they have a bunch of agents, robo-signers, sign a bunch of documents that get recorded with the county recorder that line that thing up. Those documents say, for true and valuable consideration, X bank paid Y bank for this mortgage, and so none of that stuff is true. Whether or not it's fraudulent or not, I don't have the arrogance to say something like that. I think I put a lot of those facts in front of a jury. The jury would come back and say that was fraudulent. But that's kind of my problem with a lot of judges. They think, I don't think that I own the truth. I think I've got good arguments. I think I make good analyses, and I trust juries. If I can get all the facts of these cases in front of juries, I think juries will come back and say, yeah, that was fraudulent to have a bank say that one of its employees was an employee of MERS when in fact it wasn't an employee of MERS, and sign this document that was a scam. I think the jury would come back and say that. I'm not that arrogant to say, yeah, I think this is fraudulent. The whole system is kind of an unnatural system. Our country wasn't founded with a central bank. We have a system that is, since 1971, based on fiat currency. It's not backed by any gold or silver. And then it's also a fractional reserve system. So banks are basically inherently insolvent. And if you, to just understand this in just real world terms, you just have to watch It's a Wonderful Life. Just watch that, and it explains when Uncle Billy loses the deposit, the bank's insolvent, and then all the depositors try to collect their money. And George Bailey says, well, I can't give you your money because it's in Mike's farm. Really, in a microcosm, just shows the inherent insolvency of a fractional reserve system. And to get just a little bit deeper, or maybe a little too deep, is in August 1971, we went off of the Bretton Woods gold standard, if you will. That's where the U.S. settled its accounts with other countries in gold. Nixon basically did something called shutting the gold window. And since then, our currency has been based on nothing. And if you see the real sins of the system, they really started in 1971 when our money became dross, when it was based on nothing. That's when the derivatives industry got started. That's when all kinds of crazy financial shenanigans got started, and we're really paying the price now. 2 summers ago, I was trying to help a number of people, actually, and I realized that in trying to put deals together with banks, that I was completely getting the runaround. No one had the authority to negotiate. I was generally dealing with 21-year-old people who didn't know up from down, who were asking for my clients' grocery bills and stuff like that. And then a lot of them were talking about an investor somewhere out there who didn't authorize the approval of any modification. And I had come back, I've got a finance undergrad, and I had come with some pretty sophisticated proposals for banks that were really win-win deals. A present value calculation of, X thousand dollars a month payable for 5 years, and then after that the payment goes up, and all partially based on my understanding of Austrian economics and the coming inflation. So I put together these deals, and these people just were not responding. And I was just really angry and started looking in deeper and discovered that some of the bailout laws, like the TARP law, actually encouraged banks to foreclose or to force a transaction, force a short sale. And one of the rules that I discovered was, if a bank forces a sale, they get 88% of the difference between the sale price and the original face amount of the mortgage. So if there's a $200,000 mortgage that's completely underwater, a house sells for $100,000, the bank gets $100,000, but then gets another 88 as a result of TARP bailout money. And so the bank has no incentive to work with the homeowner. If they can force that sale, they're going to get money stuffed in their back door as a result of the federal bailout. The only way to compel the banks to take action is to hit them at the heart. And the heart of this really is, and I did a lot of digging into this, talked to friends of mine who were real players in the securitization business. These are the guys who were doing securitizations all day long for 20 years, and started to figure out how securitized loans work and what in my view are the vulnerabilities in foreclosing on a securitized loan. And so ultimately came up with the idea of, the people who are in a position or are being foreclosed on are in no position to pay the $50,000 in attorney's fees to prosecute these things. So the only way to do it is to combine people by bank. So for example, the first case that we started up is 13 plaintiffs versus Bank of America, and to challenge the underlying premise of the right to foreclose, and that is really based on legal title to the promissory note. And I don't want to get into it. I can bore people with the details of it, but when you go to the closing, you sign a note, you sign a mortgage, the note gets put into something called a pooling and servicing agreement. Inside the pooling and servicing agreement, it goes into something called a special purpose entity. All the money that goes into the pooling and servicing agreement comes from outside, from what are called certificate holders. Even in in the perfect case, the way it's supposed to work is that note, a note is like a check. It's a negotiable instrument. You write a check to Countrywide for $300,000. You only write one. You wouldn't write two checks to Countrywide because it's a legally actionable document. It's a powerful document. That's what a promissory note is. And in order for someone to claim rights in a promissory note, if someone wrote you a check, I picked it up and tried to cash it, I would have to look at the bank teller would look at the back and say, okay, this check was payable to Andy, but your bill, and Andy didn't sign it on the back, pay the order of Bill. So it's very important that the subsequent alleged owners of the notes be able to prove a chain of title to the notes and show that they are the legal owners of the notes. And I don't want to get too far into this, but in my view, again, modest truth claims. I don't want to say that my view is the view. I'd like to see a jury have full access to this, but my view is that once any note goes into a pooling and servicing agreement, it no longer is a negotiable instrument. You can perfectly document and have it endorsed on the back perfectly, but it is no longer a negotiable instrument. And anybody who's coming into court claiming to be a holder in due course of that instrument, I don't think they can meet their burden of proof. So the idea with the lawsuit is to compel the banks to show legal title to promissory notes and therefore a right to foreclose. And I also have to say that in my limited experience, no bank I've seen so far has done it right. So even I haven't seen that perfect scenario that I think still doesn't work for them. The lack of private sector experience and work, and it doesn't apply to everybody. There's plenty of really great judges, and there's plenty of great judges who don't have a lot of private experience but work hard at trying to figure it out. But that is a real tough nut, is running up against a judge who doesn't have experience and doesn't care. That's the hardest part. Really helping people, when you can actually make a difference in someone's life, whether it's getting a widow $1 million settlement, or whether it's just helping some gal who's lost her nursing license get disability insurance, where it really impacts their lives and makes a difference. That's a big deal. Proceed from the heart, and figure out right from wrong, and then figure out what the legal roadmap is from there. And you come from the heart and use your brain as kind of a governor. I think that is a big difference, and between me and almost every other lawyer. I think most lawyers start here and end there, and so I start from the heart and use my head as a governor.